Usually when we talk about a medical diagnosis, there's this expectation of precision.
Oh, absolutely, yeah.
Right. It feels like engineering almost. Like you break your arm, the x-ray shows that jagged white line, and the doctor just points and says, there it is. Broken or not broken, it's clean.
Yeah, it's a binary that brings a lot of comfort, I think.
Yeah.
We naturally gravitate toward things that are, visible, categorizable, and definitively measurable.
Exactly. But then you step into the world of business finance, and suddenly that x-ray machine is just like completely broken.
Completely.
We're looking at a diagnostic landscape that is honestly incredibly murky. Specifically, when we try to answer what seems like a really simple question, what is a company actually worth right now?
Right. And it is the absolute definition of diagnostic muddy waters. Because to answer what a company is worth, you have to count what they have. And in the financial world, counting what a company has is, well, it's never just a matter of tallying up boxes.
So I want you to imagine, just for a second, a massive warehouse. It is packed to the ceiling with cardboard boxes, and inside those boxes are brand new, top-of-the-line smartphones. Right. And it seems so straightforward. Just count the boxes, multiply by the price, and, you have your value. But based on the material we are diving into today, how a business counts and assigns a dollar value to those boxes directly dictates whether the government, investors, and banks think the business is wildly profitable or on the verge of bankruptcy.
Yeah, it's huge.
Inventory isn't just a physical count. It's basically the financial heartbeat of a company. So welcome to the deep dive. Our mission today is to completely unpack Chapter 4 of a core accounting text focused entirely on inventories.
Ooh.
We want to master inventory valuation from the absolute basic definitions to the, exact mathematical formulas.
Right, making sure you are fully prepared for any exam or actual business application.
Exactly. And I'll be playing the role of the enthusiastic, curious learner today. I'm going to ask all the quote-unquote dumb questions, so you don't have to. And you, my friend, are the master teacher guiding us through this logic.
I will do my best. Those physical boxes you mentioned, they represent potential energy. They're cash that has been frozen into a physical form, waiting to be sawed back into cash when sold.
I love that. Frozen cash.
Yeah, and until they are sold, the method we use to measure that frozen potential changes the entire diagnostic picture of the business. The rules governing this are complex because, well, the stakes are just incredibly high.
Okay, let's unpack this. The core text we're analyzing today goes deep. It's a comprehensive look at inventory valuation, and it forces us to rethink what a physical asset actually means on paper. So let's start at the very beginning. What exactly qualifies as inventory?
Okay.
I mean, the traditional view is just the finished goods sitting on a shelf, right? The smartphone's waiting for a customer.
Yeah, that is the most classic definition, what we call assets held for sale in the ordinary course of business. For a retail store, a trading concern, that is basically the beginning and end of their inventory. They buy a finished product, they sell a finished product.
But the material expands on this significantly when we move away from simple retail and look at manufacturing. A company like Apple doesn't just hold finished iPhones. They hold like microchips, glass screens, lithium batteries.
Right, which introduces the whole concept of the production life cycle. Assets held in the process of production for sale are also inventory.
Okay.
So if you walk through a manufacturing plant, you see raw materials at one end. In the middle of the factory floor, you have partially assembled products. A smartphone missing its screen, for instance.
Right. It's not a phone yet, but it's not just a pile of glass either.
Exactly. That halfway point is called work in progress, or WIP. It is not ready to be sold, and you can't use it yet, but it is actively in the process of becoming a saleable good. Therefore, the value of the materials and the labor put into it so far must be captured as inventory.
That makes logical sense. Even if it's not a finished phone, the company still spent money on the battery and the casing, so it clearly holds value.
Precisely.
But then the definition stretches even further to include assets held for consumption in the production of goods or services. And the text says this includes maintenance supplies and consumables.
Yeah, think about a large commercial bakery. The flour and sugar are obvious raw materials. But what about the parchment paper they use to line the massive baking sheets, which, gets thrown away after one use?
Oh, right.
Or the food-grade grease used on the conveyor belts? These aren't part of the final product the customer actually eats, but they are consumed entirely in the process of creating that product. They are vital to the ordinary course of business, so they are categorized as inventory.
This brings up a massive area of confusion for me, and it feels like the exact kind of nuance that, trips people up on exams.
Let's hear it.
Let's go back to the smartphone factory. They have a huge, multi-million-dollar robotic arm that attaches the screens. What if the company buys a highly specialized, incredibly expensive spare motor for that specific robotic arm, just in case it breaks down? It's a spare part, so does it count as inventory?
That is a very common trap. And the accounting standards draw a very strict line here. The rule states that spare parts, servicing equipment, and standby equipment, which can be used only in connection with a specific item of fixed asset and whose use is expected to be irregular, are not classified as inventory.
Wait, if they aren't inventory, what are they?
They are accounted for as fixed assets themselves.
Really?
Yeah, the logic comes back to the fundamental nature of inventory, which is flow. Inventory is meant to be turned over, sold, or consumed relatively quickly in the normal cycle of generating revenue.
Ah, I see.
That specialized robotic arm motor, the company hopes they never have to use it. It is sitting there as a permanent backup for primary infrastructure. Because its use is irregular and tied permanently to a fixed asset, it is treated like the machine itself, depreciating over time, rather than flowing through the business as inventory.
That is a fascinating distinction. So if a factory buys 10,000 standard bolts used across 50 different machines every day, those are consumable stores, which is inventory.
Correct.
But a bespoke, custom-machined gear that only fits one machine and might sit on a shelf for 5 years, that is a fixed asset. It's all about how the item is actually consumed.
Exactly. Context dictates the accounting treatment. Another great example from the material concerns the construction industry. A half-built skyscraper feels like the ultimate fixed asset, right? It's literally a building attached to the ground.
Yeah, it doesn't get more fixed than that.
But for a construction company, whose ordinary course of business is building and selling real estate, that half-built skyscraper is just a really, really large work in progress. It is their inventory. But if a bank builds the exact same skyscraper to use as their own headquarters, then it's a fixed asset.
Context is everything. The skyscraper is either the factory or it's the product being made inside the factory. Okay, now that we have a solid grasp on what we are actually counting, I want to explore why getting the value of these items is so critical. Because the source material outlines 4 massive impacts of inventory valuation.
Yes, it does.
It lists determination of income, determination of financial position, liquidity analysis, and statutory compliance.
And honestly, misstating your inventory doesn't just cause a small hiccup. It essentially turns an entire financial statement into a work of fiction.
Let's look at liquidity analysis first. So if a company goes to a bank for a loan, the bank wants to know if they can pay their short-term bills, right?
Right. Liquidity is entirely about how quickly an organization can convert assets into cash to meet its obligations. And inventory is usually the largest component of a company's current assets. So imagine a tech retailer whose warehouse is packed with thousands of pagers from the 1990s. If they value those pagers at the high price they originally paid 30 years ago, their balance sheet will show a massive current asset value. They look highly liquid on paper.
But in reality, nobody is buying a 90s pager today. I mean, they're completely illiquid.
Exactly. The illusion of liquidity is incredibly dangerous. If the bank lends them money based on that inflated inventory value, the business will default because you cannot pay a modern electricity bill with unsold pagers. Proper valuation, writing down the value of obsolete stock, it forces the financial statement to reflect the harsh reality of the market.
Which ties directly into the determination of financial position. The closing inventory value goes straight onto the asset side of the balance sheet.
Right. An overvalued inventory artificially inflates total assets, which in turn inflates the company's equity. It paints a picture of financial health and stability that simply does not exist, misleading shareholders and potential investors.
And this is exactly why statutory compliance is so rigid. Legal frameworks like Schedule 3 to the Companies Act mentioned in the text, they require rigorous disclosure. You can't just write warehouse contents, $10 million.
No, absolutely not. You must categorize it. Raw materials, work in progress, finished goods, and you must disclose the exact accounting policies and formulas used to arrive at those numbers. Transparency is mandated because the potential for manipulation is just so high.
The potential for manipulation really becomes clear when we look at the first point, determination of income. The material makes a profound statement here. It says the effect of a misstatement of inventory on net income is always routed through the cost of goods sold. I really want to pull this apart because this is where the math dictates the reality of profit.
This is often referred to as the profit seesaw, and it is the single most vital concept in inventory accounting. To understand it, we just break down how a business calculates income. Income equals revenue minus expenses. The revenue is simply what the customer paid for the product. The expense in this context is the cost of goods sold, frequently abbreviated as COGS.
So if a retailer sells a television for $1,000 and they originally bought that television from the manufacturer for $600, the revenue is $1,000, the COGS is $600, and the gross profit is $400.
On a single item, it is that simple. But a major retailer has millions of items moving in and out every day. They cannot track the individual historical cost of every single television, cable, and battery as it goes through the checkout register.
Right, that would be impossible.
Instead, they use a formula based on the warehouse inventory to calculate their total COGS for the entire year. The formula is opening inventory plus purchases minus closing inventory equals cost of goods sold.
Let me walk through that to make sure the mechanics are crystal clear for everyone listening. Opening inventory is the value of the goods sitting in the warehouse on January 1st.
Yes.
We add purchases, which is everything the company bought from suppliers throughout the year.
Correct.
Then, on December 31st, we subtract the closing inventory, which is whatever is left sitting in the warehouse. And the resulting number is the cost of goods sold, like the value of the inventory that actually left the building and was sold to customers.
Now look at the mathematical function of the closing inventory in that equation. It is being subtracted.
Which means if I subtract a bigger number from my closing inventory, the final result, the cost of goods sold, becomes a smaller number.
And if your cost of goods sold, which is your primary expense, is smaller, your reported profit artificially increases.
This is the seesaw. Let's ground this in a physical analogy to really lock it in for exam candidates because they love testing this. Imagine I run a commercial bakery. At the start of the month, I have 10 giant bags of flour in the back room. That's my opening inventory.
Good, 10 bags.
Throughout the month, I buy 20 more bags. So in total, I had 30 bags of flour available to use. Now, at the end of the month, I need to calculate my profit. To do that, I need to know my COGS. Basically, how much flour I actually baked into bread and sold. I walk into the back room to count my closing inventory. I glance at a stack in the corner and say, looks like I have 15 bags left. So 30 bags available minus 15 bags closing inventory equals 15 bags used. My cost is 15 bags.
Seems straightforward.
But let's say I was sloppy. There were empty cardboard boxes behind the stack, making it look bigger. I didn't actually have 15 bags left, I only had 5.
Let's run the math on the reality then. 30 bags available minus an accurate closing inventory of 5 bags means you actually use 25 bags of flour to bake your bread.
Wow. So by overstating my closing stock, claiming 15 instead of 5, I accidentally assumed I used less flour. I thought I used 15 bags when I actually burned through 25.
Exactly.
If I think I use less flour, my expenses look much lower on paper. And lower expenses mean a falsely inflated profit. I might look at my books and think I'm a brilliant, highly profitable baker when in reality I am wasting raw materials at an alarming rate.
This illustrates the first major rule derived from the formula. If closing inventory is overstated, net income is overstated. They move in tandem. By falsely inflating what remains in the warehouse, you hide the true cost of what was sold, pumping up your profit margin.
And it works perfectly in reverse, right? If I underestimate my closing stock, say, I think I only have 5 bags left, but I actually have a whole other pallet of 10 bags hidden in another room, I assume I use 25 bags instead of 15. I've artificially inflated my expenses, which crushes my profit on paper. Closing inventory understated means net income is understated.
Spot on. Now, the relationship with opening inventory operates inversely. Remember the formula. Opening inventory is added to purchases. If you start the year by overstating your opening inventory, you are inflating the total pool of costs available to be sold.
Ah, okay.
A larger starting pool drives up the final cost of goods sold figure, which in turn drives your net income down.
It's a delicate balance. Closing inventory and profit move in the same direction. Opening inventory and profit move in opposite directions. It suddenly makes perfect sense why auditors spend weeks in massive warehouses just counting boxes. If the closing inventory number is wrong, every single profit metric presented to Wall Street is compromised.
It is the foundation of the income statement. Which brings us to the most critical challenge. Counting the bags of flour is actually the easy part. Determining the exact dollar value to assign to those bags is where the real complexity lies.
Right. And the source material introduces what it essentially treats as the golden rule of inventory valuation. It states that inventories should generally be valued at the lower of cost or net realizable value, lower of cost or NRV, whichever is lower. Why don't companies just value inventory at the price they paid for it or the price they intend to sell it for?
This rule is born from the principle of conservative accounting. The accounting profession is fundamentally and intentionally pessimistic.
Pessimistic.
Yes. The core tenet of this principle is that a business must recognize anticipated losses immediately, but it cannot recognize anticipated profits until they are actually realized.
Let's apply that to the smartphone warehouse. I buy a massive shipment of phones directly from the manufacturer for $600 a piece. That's my historical cost. I plan to sell them retail for $1,000. Can I put them on my balance sheet at $1,000?
Under conservative accounting, absolutely not. You have not made a sale. The customer hasn't handed you their credit card. You cannot count your chickens before they hatch because 1,000 different things could prevent that sale from happening. The ceiling of your valuation is always your historical cost, $600.
That makes intuitive sense. Don't claim money you haven't made. But what happens if the market shifts? What if a rival company releases a much better phone the very next day and consumer demand for my inventory just vanishes? The real-world retail price drops to $400.
This is where the pessimism of the standard takes over. Your historical cost is $600. But the net realizable value, what you can actually extract from the market today, is only $400. The rule demands you take the lower number. You are forced to immediately write down the value of that inventory on your books to $400.
Even though I haven't sold the phone yet, I have to take a $200 loss right now.
Immediately.
No.
Because the loss is anticipated and highly probable. Conservative accounting requires you to absorb the blow on your financial statements right now. It prevents companies from carrying obsolete, worthless junk on their balance sheets at their original inflated purchase prices. It forces a brutal honesty about the true state of the company's assets.
Wow. So we need to be very precise about what net realizable value actually means, because the text defines it as the estimated selling price in the ordinary course of business, less the estimated costs of completion and the estimated costs necessary to make the sale.
It's a crucial distinction. NRV is not merely the sticker price. If you have a finished product with a sticker price of $400, but you have to pay a sales platform a $50 commission to process the transaction, your true NRV is $350. You must deduct the cost required to execute the sale.
And for work in progress, it's even more involved, right? If I have a partially assembled phone, I might estimate the final selling price at $400. But if it's going to cost me $100 in labor and parts to finish building it, plus the $50 sales commission, the NRV of that unfinished phone sitting on the workbench is $400 minus $100 minus $50. The NRV is $250.
Exactly. It is a calculation of the net cash flow you expect that specific physical item to generate, accounting for the friction of finishing and selling it. Interestingly, the text notes a specific application for raw materials. For raw materials, replacement cost is generally considered the net realizable value.
Why replacement cost?
Because a manufacturer typically doesn't sell raw materials, they consume them. A car manufacturer doesn't sell rolls of sheet metal. So the value of that sheet metal to the business is what it would cost to go out and buy it in the open market today to maintain production. If global steel prices plummet, the value of the steel sitting in the factory drops in tandem, reflecting the new, lower replacement cost.
To see how this works in a complex inventory, the text provides a detailed illustration involving a company called Sarika Ltd. This company deals in 3 completely independent products: Item P, Item Q, and Item R. We are at the end of the year trying to find the total value of their closing stock. Let me run through the numbers.
Let's do it.
Item P has a historical cost of 38 and an NRV of 42. Item Q has a cost of 29 and an NRV of 29. Item R has a cost of 17 and an NRV of 14. How do we apply the golden rule to this mixed bag?
The standard dictates that the comparison between cost and NRV should be made on an item-by-item basis. So evaluating item P cost is 38, NRV is 72, the lower figure is cost, so item P is valued at 38, completely ignoring the anticipated profit of 4.
Right, because we can't count unearned profit.
Exactly. Then item Q cost is 29, NRV is 29. They are identical, so the value is 29.
Simple enough.
Finally, item R cost is 17, NRV is 14. The market value has dropped below our historical cost. We must recognize this loss immediately. Item R is valued at the lower NRV of 14. The total valuation for Sarika Ltd. is the sum of these individual lower values, 38 plus 29 plus 14, giving a total inventory value of 81.
I really want to challenge this item-by-item methodology because in a real-world scenario, a company like Amazon has millions of different SKUs. Evaluating lower of cost or NRV item by item seems incredibly tedious. Why couldn't Sarika Ltd. just aggregate the totals?
It's a fair question.
Let's look at the math if they did. The total cost of all 3 items combined, so 38 plus 29 plus 17 is 84. The total NRV of all 3 items combined, 42 plus 29 plus 14 is 85. If we just compare the grand totals, the total cost, 84, is lower than the total NRV, 85. So under an aggregated method, the total inventory would be valued at 84, but the item-by-item method forced us to value it at 81. Why is 84 considered incorrect?
This goes directly to the heart of why accounting standards exist to prevent manipulation. Look closely at what happens when you aggregate the totals. You are allowing the unrealized gain on item P, the fact that its market value is 4 higher than its cost, to mask the very real realized loss on item R, which has dropped in value by 3. Oh, wow. By clumping them together, I'm using a profit I haven't even made yet on item P to hide the fact that I'm actually losing money on item R.
Exactly. And conservative accounting strictly forbids using anticipated unearned profits to offset current actual losses.
If you value the whole warehouse at 84, your financial statements show no loss in inventory value. But the reality is that a segment of your inventory, item R, is deteriorating in value. The item-by-item rule acts as an anti-hiding mechanism. It ensures every single specific loss is exposed and recognized on the income statement, and no unearned profits are allowed to artificially prop up the balance sheet.
That is brilliant. It forces absolute transparency at a granular level. So the golden rule of lower of cost, or NRV, holds up. But this brings us to a major logistical question. We keep throwing around the word cost. What exactly constitutes the historical cost of an item? I mean, it can't just be the sticker price on the supplier's invoice.
No, it's much broader than the invoice price. The text categorizes cost into 3 main buckets: costs of purchase, costs of conversion, and other costs incurred in bringing the inventories to their present location and condition.
Costs of purchase seems the most obvious. You pay for the item, but what else gets lumped into this bucket?
It includes duties, non-recoverable taxes, freight inwards, meaning the transportation cost to physically move the goods from the supplier to your warehouse, and any other expenditure directly attributable to the acquisition. And conversely, you must subtract any trade discounts, rebates, or duty drawbacks you receive from the supplier.
Okay, the text highlights a very specific scenario regarding taxes, specifically GST, which feels like a classic pitfall for anyone trying to calculate true costs for an exam.
Oh, it is a massive trap.
Imagine I buy 100 units of a raw material at 100 rupees per unit. The supplier also charges an 18% GST. The base price is 10,000 rupees. The 18% GST adds 1,800 rupees, so the actual cash leaving my bank account to pay the supplier is 11,800 rupees. Is my cost of purchase 11,800?
No. And this concept is fundamental to understanding modern value-added tax systems. The standard explicitly states that the purchase price includes duties and taxes other than those subsequently recoverable by the enterprise from the taxing authority.
Or recoverable taxes, so because GST operates on an input tax credit system.
Exactly. The 1,800 rupees you paid in GST is essentially a temporary deposit with the government. When you eventually sell your finished product and collect GST from your final customer, you get to deduct that 1,800 rupees from what you owe the government. Because you will recover that money, it is not a true permanent cost to your business. Therefore, it cannot be capitalized into the value of your inventory. Your cost of purchase remains strictly the base price of 10,000 rupees.
If a company erroneously included recoverable taxes in their inventory cost, they would be massively inflating their asset values with money that is basically just passing through to the government. That would completely skew the profit seesaw we talked about earlier.
It would ruin the whole calculation.
What about the second bucket? Costs of conversion.
This applies almost exclusively to work in progress and finished goods in a manufacturing setting. It includes costs directly related to the units of production, such as direct labor, the hourly wages of the workers assembling the smartphones. But it also requires a systematic allocation of factory overheads, both fixed and variable.
So the electricity used to run the robotic arms, the depreciation of the factory building, the salary of the factory floor manager.
Yes. Those overhead costs are slowly absorbed into the value of the inventory as it moves down the assembly line. And the third bucket, other costs, is a catch-all for expenditures necessary to bring the goods to their present condition. A classic example is a cheesemaker. The electricity and maintenance costs for a climate-controlled aging cave are other costs necessary to bring the cheese to its final saleable condition.
Understanding what goes into the cost is crucial, but the text spends significant time detailing what must be excluded. There are 4 major exclusions. As I was reviewing the material, the reasons behind these exclusions paint a really clear picture of what accounting tries to prevent. The exclusions are abnormal waste, storage costs, administrative overheads, and selling costs. It actually spells out a neat acronym if you look at the first letters. A, SAS. Let's analyze why each of these is banned from being included in inventory cost, starting with abnormal waste.
To understand abnormal waste, we have to recognize normal waste first. If a furniture maker buys large planks of wood to cut out circular tabletops, there will inevitably be sawdust and scrap corners. That is a normal, unavoidable cost of the production process, and the cost of that scrap wood is absorbed into the value of the finished tables.
Makes sense.
But abnormal waste is entirely dissonant. Imagine a pipe bursts in the factory and ruins half a shipment of wood. Or a machine is poorly maintained and shreds 1,000 units of raw material.
Or a forklift driver accidentally backs over a pallet of finished smartphones.
Exactly. Those events represent inefficiency, accidents, or incompetence. If a company were allowed to take the financial loss of those crushed smartphones and just spread it out, adding it to the cost of the surviving smartphones, what are they actually doing? They are artificially inflating the value of their remaining assets simply because they had an accident.
They would be capitalizing their own incompetence. A poorly run factory would magically produce higher value inventory on the balance sheet just because they waste so much money.
Which is an absurdity that accounting standards prevent. Abnormal waste must be written off immediately as an expense in the current period, taking a direct hit to the profit line. It can never be capitalized into inventory.
That makes perfect sense. The first S in that ASAS acronym is storage costs. Why exclude storage? I mean, it costs money to run a warehouse to hold inventory.
It does, but general storage of finished goods doesn't add any inherent value to the product itself. Storing a finished smartphone for 6 months doesn't make it faster or give it a better camera. It is merely a holding cost. There is a key exception, however. Storage costs are included if they are necessary in the production process prior to a further stage. Like the cheesemaker we discussed. Storing the cheese in the cave is an active part of the production process. But once the cheese is fully aged and ready for sale, any subsequent storage costs while waiting for a buyer are excluded.
The A is for administrative overheads.
The CEO's salary, the legal department, human resources. These are vital functions for the corporate entity, but they do not contribute to bringing specific physical inventory to its present location and condition. They don't touch the product on the factory floor, so their costs are expensed separately, not baked into the inventory value.
And finally, the last S, selling and distribution costs.
Sales commissions, national advertising campaigns, the fuel to deliver the product to the final customer. These are costs incurred to get rid of the inventory, to execute the sale. They have nothing to do with acquiring or building the asset in the first place, so they are excluded.
Abnormal, storage, admin, selling, ASAS. It's a very logical set of boundaries to prevent companies from artificially inflating their assets with irrelevant expenses. But now we face a massive logistical hurdle. We know exactly what goes into the cost of a single item. But a major business doesn't buy one item at a time. They are buying materials in January for $10, in March for $12, in June for $11. How on earth do they physically keep track of all these changing costs throughout the year?
Well, the material outlines 2 primary logistical systems, the periodic system and the perpetual system. The periodic system is the traditional historical method of inventory management. It relies entirely on a physical count at a specific date, usually the final day of the financial year. Under a purely periodic system, a company does not track the cost of every single item as it is sold throughout the year.
They just keep a ledger of all their purchases. Then, on December 31st, they shut down the warehouse, send in teams with clipboards, and physically count every single box remaining. This takes us right back to that COGS formula. Opening inventory from last year's count, plus purchases from the ledger, minus the closing inventory, which they just manually counted, equals the cost of goods sold.
Exactly. Under the periodic system, the cost of goods sold is a residual figure. It is whatever number falls out of the bottom of that equation.
The best way to visualize this is how most people manage their home refrigerator. I know what was in the fridge on Monday morning. I have the receipts for my grocery run on Wednesday. But on Sunday night, I don't have a spreadsheet of every single snack I ate. To figure out what I consumed, I just open the fridge, see what's left, and assume I ate whatever is missing.
That analogy perfectly highlights the primary limitation of the periodic system. What if you didn't eat the missing food? What if it spoiled and you threw it in the trash? What if a roommate took it? Because cost of goods sold is a residual balancing figure in this system, it blindly lumps legitimate sales together with theft, spoilage, breakage, and clerical errors. Management has no real-time control or visibility into inventory leakage.
Which explains why the text notes this system is usually reserved for smaller enterprises where physical control is easy. A corner bookstore can probably manage with a periodic system. A multinational electronics manufacturer cannot, which necessitates the perpetual system.
Yes, the perpetual inventory system is a continuous rolling record. It involves updating inventory balances after every single receipt of goods and every single issue of goods. You maintain a highly detailed inventory ledger. Every time a unit arrives, it is logged. Every time a unit is sold, it is deducted. And the cost of goods sold for that specific transaction is recorded instantly.
Upgrading the analogy, a perpetual system is like owning a hyper-advanced smart fridge. Every time I put an egg in, the fridge scans a microscopic barcode. Every time I take an egg out to make an omelet, the fridge scans it again, deducts it from the total, and instantly logs that I consumed an egg costing 20 cents. I have total, real-time visibility.
Under a perpetual system, cost of goods sold is directly determined at the moment of sale. The closing inventory is the residual figure. It's what the ledger says should be in the warehouse. Companies using this system still conduct physical counts periodically, of course, to verify that reality matches the ledger, to ensure an egg didn't break without the fridge noticing, but the financial books are updated continuously.
With the advent of barcodes, RFID tags, and massive ERP software systems, the perpetual system seems vastly superior. But even with the most advanced software, we hit a complex mathematical wall when dealing with interchangeable goods. Let's say I'm using perpetual system. I sell a smartphone today. I walk into the warehouse, and there are thousands of identical boxes. Some I bought in January for $600, some I bought in June for $650. When I pull one box off the shelf and hand it to the delivery driver, which historical price tag do I attach to it?
The material poses a vital preliminary question before we can answer that. Is the inventory ordinarily interchangeable? Are the items functionally identical? If the inventory is not interchangeable and the items have high individual value, you don't use a formula at all. You use the specific identification method.
This makes perfect sense for specific industries. An art gallery doesn't use an average price for paintings. When they sell a Picasso, the cost of goods sold is the exact specific historical cost of that individual Picasso. A car dealership tracks inventory by unique VIN numbers.
Custom jewelry, heavy bespoke machinery, bespoke real estate, these require specific identification. You track the exact cost of the exact item. But if you have a massive bin containing 2 million identical industrial screws, purchased in 50 different batches at slightly varying prices throughout the year, specific identification is physically impossible and administratively absurd. You cannot track the unique cost of a single screw. For interchangeable inventory, accounting standards require the adoption of an assumption about how costs flow through the business. The primary historical cost formulas discussed are FIFO, LIFO, and average prices.
Let's start with FIFO, first in, first out. Logically, this feels like the most natural assumption for how a business operates.
FIFO assumes that the issue of goods from inventory is made from the earliest lot on hand. The goods that were purchased first are the ones sold first. Consequently, the closing inventory sitting in the warehouse at year-end is assumed to consist of the latest, most recently purchased consignments.
From a physical standpoint, this is exactly how a grocery store manages perishable goods, like milk. You put the older milk at the front of the display so customers buy it first, and you stock the new milk at the back. First in, first out.
It aligns perfectly with perishables. But the text makes a crucial conceptual distinction. FIFO is an accounting assumption of cost flow. It does not mandate that the physical goods must actually move in that exact order. Imagine a power plant with a massive continuous silo of identical coal. Every week, new coal is dumped into the top of the silo. When the plant needs to burn coal, they extract it from the top. Physically, they're using the newest coal first, last in, first out.
Oh, I see.
But for accounting valuation purposes, the plant can still use the FIFO formula. It simply assumes that the financial cost of the oldest coal is what is being expensed, regardless of which physical lump of coal was actually burned. The accounting tracks the flow of dollars, not necessarily the flow of atoms.
That is a profound distinction. The physical reality and the financial reality can operate on different logical tracks so long as the financial assumption is consistent. To see how this impacts the balance sheet, let's walk through the math. The text provides a detailed scenario, illustration 2, dealing with a manufacturer purchasing condensers.
Okay, let's break it down.
Here is a purchasing activity for the month of December. December 4, they bought 900 units at $50 each. December 10th, they bought 400 units at $55 each. December 11, they bought 300 units at $55 each. December 19, they bought 200 units at $60 each. And December 28, they bought 800 units at $47 each. That's a total of 2,600 units purchased across 5 different batches.
Got it.
During the month, the factory issued 1,600 units to the production line. So 2,600 total units minus 1,600 issued leaves a closing stock of 1,000 units. how do we use FIFO to put a dollar value on those 1,000 remaining units?
We rely on the core FIFO assumption. The oldest units were used first. The 1,600 units that were issued burned completely through the oldest batches. They consumed the entire December 4 batch, the entire December 10 batch, and part of the December 11 batch. Therefore, the 1,000 units still sitting in the warehouse must be the absolute newest units we acquired. To value them, we start at the most recent purchase and count backwards until we hit our total of 1,000 units.
Okay, so our most recent purchase was on December 28th, where we bought 800 units at 47.
So we take those 800 units and value them at their specific purchase price. 800 units at 47 equals $37,600. But our closing stock is 1,000 units. We need 200 more units to complete the valuation. We step backwards in time to the next most recent purchase.
The previous purchase was December 19th, where we bought 200 units at 60.
Those 200 units must also still be in the warehouse. 200 units at 60 equals $12,000. We have now accounted for all 1,000 units in the closing inventory. We sum the values. $37,600 from the December 28 batch plus $12,000 from the December 19 batch equals a total FIFO closing inventory value of $49,600.
It's a very clean, structured process. You just scrape the newest layers of inventory until you fill your closing stock quota. One of the major benefits of FIFO is that the inventory value on your balance sheet is based on the most recent market prices, so it closely reflects the current economic reality, which leads us to the polar opposite, LIFO, or last in, first out.
LIFO flips the assumption entirely. It assumes that the cost of goods sold is assigned the cost of the goods purchased last. The newest inventory is expensed first. Consequently, the closing inventory left on the balance sheet is assumed to consist of the earliest, oldest consignments.
If FIFO is the milk aisle, LIFO is, well, it's hard to imagine a business that physically operates this way intentionally, other than maybe a gravel pit where you dump new gravel on top of a pile and scoop from the top. Why would accountants ever develop a system that assumes you are hoarding your oldest inventory forever?
The historical argument for LIFO is rooted in the income statement, specifically in matching current costs against current revenues. If you sell a product today, advocates of LIFO argue you should match that revenue with what it costs to replace that product today, which is best represented by your most recent purchase prices. In periods of high inflation where prices are constantly rising, using LIFO means your cost of goods sold is calculated using the newest, highest prices. Higher COGS means lower reported net income, and lower net income in jurisdictions that allowed LIFO meant significantly lower income tax liabilities.
So it was largely a tax optimization strategy masquerading as an inventory assumption.
To a significant degree, yes. But the consequence on the balance sheet is severe. If a company uses LIFO for decades during an inflationary period, their balance sheet will value their current inventory at prices from 20 years ago. It renders the balance sheet completely detached from current economic reality, hiding the true value of the company's assets. Because of this profound distortion, the text reveals a critical update. LIFO is based on an irrational assumption contradictory to the actual flow of goods in almost all businesses. Therefore, modern accounting standards do not permit the usage of the LIFO method.
Wow, it is essentially a banned practice in standard international reporting. But the material includes a fascinating mathematical quirk regarding LIFO that perfectly illustrates the difference between periodic and perpetual tracking systems. And honestly, it proves exactly why LIFO is so problematic.
The textbook walks through a complex LIFO calculation using a perpetual system, subtracting issues chronologically from the newest stock available on the exact date of each issue. That rigorous perpetual calculation yields a closing stock value of $50,600. But then it attempts to show how to calculate LIFO under a periodic system.
Right, and when I was reading the textbook's example for LIFO periodic, I had to stop and reread it 3 times. The text states that under LIFO periodic, you wait until the end of the month, see you have 1,000 units left, and assume they are the oldest ones. But look at the actual math the textbook provides for LIFO periodic. It calculates the 1,000 units by taking 800 units from the December 28th batch at 47 and 200 units from the December 19th batch at 60. The total is 49,600.
That is exactly the same math, using the exact same newest batches, yielding the exact same final result as the FIFO calculation we just did.
Exactly. It's crazy.
It is a remarkable anomaly within the source text itself. By applying the blunt mechanics of a year-end periodic system to a LIFO assumption, the math effectively collapses in on itself and replicates FIFO. It takes the most recent purchases instead of the oldest. This exact kind of systemic unreliability, where changing your record-keeping frequency completely inverts your cost flow assumption, is precisely why regulatory bodies abandon LIFO. A valuation method cannot be considered reliable if it produces wildly contradictory results based merely on whether you update your ledger daily or monthly.
The math itself just breaks down completely, so LIFO is off the table. But maintaining a strict FIFO system, especially a perpetual one tracking dozens of different price tranches, can still be administratively heavy. Are there methods to just smooth out the volatility of changing prices? The material details average price methods, specifically simple average and weighted average.
The simple average method is exactly what it sounds like. You take the various prices you paid during the year, sum them up, and divide by the number of different prices.
Okay, using our condenser example, we had 5 purchase dates with 5 distinct prices: 50, 55, 55, 60, and 47. We add those together. 50 plus 55 plus 55 plus 60 plus 47 is 267. Divide by 5, which is the number of different prices, and we get a simple average price of $53.4 per unit. Our 1,000 closing units, valued at $53.4 each, gives a total inventory value of $53,400. I mean, the math is incredibly fast.
It is fast, and it is sometimes used by small entities operating a periodic system. But it contains a fatal statistical flaw when applied to real-world purchasing behavior.
The flaw becomes obvious if you imagine extreme volume differences. What if, on 4 of those dates, I only bought one single unit at those various prices, but on the final date, when the price dropped to 47, I bought 1,000,000 units? The simple average formula still just adds the 5 prices and divides by 5, resulting in an average of 53.4. But my warehouse is almost entirely filled with units that cost 47. The simple average completely ignores the volume, which would catastrophically overvalue my inventory.
It treats a purchase of 1 unit as having the same economic weight as a purchase of 1,000,000 units. It is statistically unsound for any business with fluctuating order sizes. To correct this, we use the weighted average price method. This method calculates the average cost per unit based on both the total money spent and the total units acquired. The formula is total cost of goods available for sale divided by the sale. Total number of units available for sale.
Let's run the weighted average for a periodic system calculated once at the end of the month. We purchased a total of 2,600 units of condensers. If we multiply out the cost of every single batch, 900 times 50 plus 400 times 55, and so on, and add them all together, our total financial spend for the month was $133,100. We take the total cost, $133,100, and divide it by the total units, 2,600. This gives us a weighted average of 51.19 per unit. Our 1,000 closing units multiplied by 51.19 equals 51,190. That reflects the actual volume purchased much more accurately than the simple average.
It is the standard approach for companies wanting a smooth cost flow. Again, that was a periodic calculation done retroactively. What happens if a company wants to use a weighted average, but they operate a perpetual, continuous inventory system? This requires a rolling calculation that is mathematically grueling but highly precise.
Yes.
Under a perpetual weighted average system, every single time a new batch of inventory arrives at a new price, the accounting system must instantly calculate a brand new average rate before the next unit can be sold. Let's step through the very beginning of this rolling process to see how demanding it is. On December 4, we receive our first shipment, 900 units of 50. Our total inventory balance is 900 units valued at $45,000. The average rate is obviously 50.
Right.
Then on December 10th, a new shipment arrives, 400 units at 55. We don't issue any stock, we just add this new batch to the pile. Our new total quantity is 900 plus 400, equaling 1,300 units. Our new total financial value is the old 45,000 plus the new 22,000, which is 400 times 55, equaling 67,000. Okay, stop there. Now, before we can do anything else, we must find the new average rate. We divide the new total value, 67,000, by the new total quantity, 1,300. This results in a new average rate of roughly 51.53.
And that new rate of 51.53 is locked in. If the factory requests components the next day, they are issued at a cost of 51.53 per unit. But a few days later, on December 19th, another shipment arrives at 60 per unit. The system must merge the remaining old stock with the new stock, sum the total values, and calculate yet another new average rate.
It is a continuous, perpetual reweighting of the inventory value every time new costs are introduced into the system. If you follow the textbook's chart for this entire month, rolling the averages through all the receipts and issues, the final perpetual weighted average rate settles at 50.37 per unit. Therefore, the closing stock of 1,000 units is valued at $50,377.
This brings us to an incredible realization about the entire field of inventory valuation. We started with 1,000 identical condensers sitting in a warehouse. The physical boxes have not changed. But look at how the financial reality reported to the world shifts entirely based on the accounting policy chosen. If management selects FIFO, the inventory is valued at $49,600.
If they use simple average, it's 53,400.
If they use periodic weighted average, it's 51,190.
And if they use perpetual weighted average, it's 50,377.
The exact same physical reality produces thousands of dollars of variance in reported profit and asset value purely based on the mathematical lens we look through.
It is the ultimate proof that the diagnostic X-ray machine of finance is indeed murky. There is no single, objective, true value of inventory in a fluctuating market. There is only the value as determined by a consistently applied, logically sound, and fully transparent accounting policy. The goal of these standards isn't to find a perfect truth, but to prevent manipulation and ensure comparability year over year.
As we step back and look at everything we've analyzed, the architecture of these rules is fascinating. We've navigated the difference between finished goods and work in progress. We've seen how keeping machinery spares off the inventory ledger prevents distortion. We've dissected the profit seesaw, proving how inflating the warehouse count artificially inflates income.
We established the deeply pessimistic yet protective golden rule of loader of cost or net realizable value, applying it item by item to expose hidden losses.
We stripped out abnormal waste, storage, admin, and selling costs to find the true, pure cost of acquisition, remembering that ASAS mnemonic. We contrasted the retroactive nature of periodic systems with the continuous, real-time control of perpetual systems. And finally, we ground through the cost flow assumptions, seeing why FIFO is standard, LIFO is banned, and weighted averages require rolling precision.
The material builds a complete, interconnected framework. Every rule, from the treatment of recoverable taxes to the exclusion of abnormal waste, exists to protect the integrity of the final income statement.
I want to end on a thought that pushes beyond the boundaries of this specific text. All of these rules, the formulas, the physical counts, they are entirely built around physical atoms. Flour, smartphones, steel, condensers. Goods that take up space, require warehouses, and cost money to transport.
Right, the traditional economy.
Exactly. But the global economy is increasingly digital. Companies are generating billions by selling software licenses, digital assets, in-game currencies, and subscription-based AI computing power. When a company has an infinite, instantly duplicable digital copy of a video game or a piece of enterprise software, what exactly is the cost of goods sold for the next digital download?
It's basically zero.
Right. And how do you apply the concept of abnormal waste to a server farm? As value shifts from physical boxes and warehouses to intangible bits on servers, the centuries-old physical definitions of inventory are going to face massive structural stress. The principles of matching costs and preventing manipulation will remain vital, but the mechanics of how we count and value assets will have to evolve dramatically.
The underlying logic of valuation is sound, but you are absolutely right. The paradigms of application are shifting. The accounting profession is going to have to upgrade its diagnostic tools for an intangible world.
A massive conceptual shift to think about as you view the businesses around you. The murky waters of diagnostic finance only begin to clear up when you understand exactly how the boxes or the bytes are being counted. Thank you for joining us on this deep dive. Keep learning, and we'll catch you next time.